Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:20 in the afternoon on Friday, the 21st of March here in New York. Gold's trading off about $25 right now at $3,018, $3,019. Silver's off about 54 cents, around 33.45. Platinum is off as well. Palladium is up. I wanted to point out at the outset, we won't be doing a video next Tuesday because we will be doing our gold yearbook release and briefing. And that is available. People can sign up and plug in. It's a live broadcast where we talk about the findings of our 2025 gold yearbook. And then there's a question and answer period. That's next Tuesday. I also want to say that I'll be speaking a little bit today about economic conditions. The gold yearbook, the first chapter is a review and outlook. The second chapter is investment demand. And the investment demand chapter has a large discussion about the economic outlook for the United States and the world, because that's really the thing that flavors investment demand, which is what drives the price. Right now, I want to talk about the key FOMC information that we culled from the FOMC's statement and release of its economic projections. Some silly comments that we've been hearing about Basel III and COMEX related to gold, just to sort of bat those scare tactics down, and then I'll update our views of the markets. Our view was that there were two key revelations that we took away from the FOMC's meeting and communiques that maybe were kind of overlooked by the markets so far. The first one is the Fed foresees major deterioration in the U.S. economy. The Fed, like other government, quasi-government organizations, the IMF, the OECD, the World Bank, they tend not to project recessions, but they will show information that points to severe concerns about potential for negative economic data. And I'll show you some data in a second from the Fed, from this week's release, that points to severe concerns at the Fed about economic conditions this year and going forward. The other thing that we took away is that the Fed's girding its loins to need to absorb increased Treasury securities to finance sharply larger fiscal deficits coming down the road. But I'll show you the information that makes us think that. First off, this is the data that the economic projections that the FOMC members had under it all. And the important thing to look at is the change between the December projections, the last time they released their projections, and their current expectations. And you can see worse conditions, expectations across the board. In terms of real GDP, economic growth, in December, they were thinking about 2.1% for 2025 for the United States, down from about 2.8% in 2024. And then 2% 2026, 1.9% in 2027. Now they're looking at 1.7% real GDP for this year, 1.8% for the next 2 years after this year. That's a significant deterioration in their economic expectations. They're not going so far as saying we think that there'll be a recession, although you could easily have a recession, 2 quarters of negative growth, and come up with 1.7% for the full year real GDP. It's been done before. What they're showing is expectations of much worse, much lower, smaller economic expansions over the next 3 years, especially this year. Similarly, with unemployment, they went from a 4.3% projection to a 4.4%. That's not too much different, but it is significant. And their inflation figures, they went from 2.5% for the personal consumption expenditure index. They went from 2.5% in December to 2.7, and 2.1 to 2.2 for next year, and 2.0 for going forward. And their core PCE is going from 2.5 to 2.8 this year. So the Fed is politely pointing to its expectations of much worse economic conditions now than it had 3 months ago. And of course, the big development in those ensuing 3 months was the arrival of the Trump administration. The Fed also expects to be buying more treasuries to cover larger deficits. This is a excerpt from its statement. There's the lease, so the link, so you could actually go online and read the Fed statement, as opposed to listening to somebody else tell you about it. But the committees continue reducing its holdings of Treasury securities and agency debt and mortgage-backed securities. Beginning in April, next month, the committee will slow the pace of decline in its securities holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. That is an enormous reduction in the amount of treasuries that it will allow to mature that it's not going to replace with new treasury purchases. That's how it reduces its balance sheet. It allows treasury securities that it's holding to mature, and it doesn't buy replacement securities. And it's saying that it's going to reduce that rate of reduction in its treasury holdings going forward, beginning next month, by $20 billion a month. That's an 80% cutback in their move to reduce their balance sheet holdings of Treasury securities. It's going to continue to reduce its agency debt and its agency mortgage-backed securities debt. Wants to get rid of that stuff because, we often say that the way an investor prepares for a hostile financial event, crisis, you reduce your debt, you get rid of those securities and investments that are the weakest, agency debt, you raise cash, and you buy gold. And the Treasury is saying, we're going to continue to reduce our debt, and we're going to get rid of the stuff that we think is more dangerous, but we're making room in the expectation that we're going to have to be buying treasuries in a much weaker, more hostile economic and financial environment. Now, here's one chart. This is the Fed's total major assets, and the blue stuff at the bottom are treasury securities. You can see they rose very sharply during the pandemic and the aftermath of the pandemic. They have been reducing their treasury holdings. I'll show you just the treasury holdings in a second, as well as other assets. But the bulk of what they own are treasury securities, and the bulk of what they're reducing are treasury securities. This is just the treasury holdings, right? You can see it got over $6 trillion in 2021 into either late 2021 or early 2022. They have gotten it down below $5 trillion. So they've reduced their treasury holdings sharply over the last 2.5 years. Why? Because they're getting ready for the next crisis where they'll have to buy more treasuries to finance higher fiscal deficits in an environment where investors don't want them. Right now, we've seen a tremendous demand for treasury securities, not only in the United States among investors, but also overseas. Overseas holdings of U.S. treasuries are at record levels. They rose 10.5% in 2023 to $8 trillion. They rose another 7.4% in 2024 to around $10 trillion. The world is awash in cash right now. And that cash is being held, a lot of it, in Treasury securities. The Fed has been reducing its Treasury holdings because it knows that when things get tough and the fiscal deficits fly off the handle, that they need to step up and be the buyers of last resort of Treasury securities. And that's what they're looking at. So, sorry about the title here, but the key is the reduction in the rate of reducing its Treasury holdings from 25 billion to 5 billion per month. This indicates that the Fed is expecting larger deficits to finance than it was just a month or two ago. It's not particularly looking for deficit and debt reductions under the current administration. It seems to be indicating that it expects that it will be required to buy a lot more treasuries, and the market may not want to buy treasuries at what the U.S. government would consider reasonable rates. So what lies ahead is most likely is not stagflation as a lot of people think about it. It is higher costs. It's higher inflation. It's not the 14% inflation we saw in 1979, but it's higher inflation. It's not 2%. It might be 3%. It might be 4%, right? Higher inflation coupled with lower real economic activity, real economic growth will be impeded. There'll be higher unemployment. There'll be slower employment growth. And there'll be a much more stringent capital availability because the higher government borrowing will be choking off or squeezing out the available credit and lending capacity available to private businesses and consumers. It could be a recession. It could be a double dip recession like we saw in 1980 and then again in 1981 and 82. But it's going to be a much more hostile time. It may not be stagflation the way we experienced it in the 70s, those of us who were around, but it's probably not going to be very good. And that's good for gold. Now, a couple things. There's some silly comments being made about gold and Basel III and gold and the COMEX. And it just, it's garbage. Basel III, which comes into effect later this year for the U.S. banks, does not require private banks to include their gold as Tier 1 assets. It allows them to, and they already are allowed to. And Basel III does not require private banks to call in their gold leases because those gold leases somehow or other, I can't remember the term right now, represent calls on those gold assets. So there are people talking about how Basel III is going to cause the banks to have to call in all their gold leases, and the gold price is going to rise sharply because the banks don't have that gold. It's all nonsense. It's just a sleeper, right? Meanwhile, another thing came up. The CME announced that it was delisting 4 moribund futures contracts. It delisted 4 of them. The Kilo contract, which it started at some point a while back, hasn't traded since April 2018. Of the other 3, one was a London spot gold futures contract and another was a London spot silver futures contract. They never traded a single time in the more than a decade that they have been available to the market. So you have moribund futures contracts that aren't trading. There are others in there. There's aluminum. Aluminum actually trades, but uranium doesn't trade. The prices are artificially set. They're taken off of other uranium markets. And there's a similar contract on cobalt, I believe. Doesn't trade. The prices at settlement are taken from other cobalt markets, right? But the COMEX is basically saying we're clearing out the closet. We have these contracts there. And quite frankly, contracts that don't trade are very vulnerable to someone coming in and trading them in a very illiquid way and skewing the prices. So it's better if you have a contract that no one wants to trade to get rid of it than to just leave it there. It has nothing to do with the disaggregation of London to New York or anything like that. It's no reason for anybody to be afraid. You should congratulate the COMEX and the CME group for not being hoarders and hanging on to contracts that really just never gelled with investors or hedgers. Talk about the precious metals markets. As I said, gold prices are off today about $25. They're still above $3,000. They got down as low as $3,004 this morning here in New York. Our expectation is that they might weaken a little bit more over the next week or two. But the reality is that the economic and political and financial market environment is extremely hostile to economic activity and consumers and businesses. And there is an enormous amount of cash that's lying there in the world that I mentioned earlier, looking for suitable investments. That will keep a floor on gold prices. The concerns, fears, if you want to use that word, and the enormous amount of money looking for good investments. That'll keep a floor on gold prices. Could gold prices fall, another $200? Yes. If you look at this chart, gold prices rose $350 between December and February. In 2 months, gold prices rose $350. Yeah, that was the average price in the 90s, probably. Okay. Came off $150 from mid-February into early March, and it's up $200 now from that early March low. It's risen $200 in the last couple of weeks. Could it rise another $150 and you have what technicians would call a measure and move? Absolutely. That would put gold prices as high as $3,200. That's not to say that the gold price might fall below $3,000 in the near term over the next week or two, but it does point to the idea that investors around the world are buying very large amounts of gold this year because of the economic and political concerns they have. And that's probably going to continue at least through April. The April contract on the COMEX futures market becomes deliverable next a week from Monday. So the 31st of March, the April contract will become deliverable. There are about 25 million ounces of open interest in the April contract. There's 20 million ounces of registered COMEX gold stocks, 20 million ounces of eligible gold stocks, 40 million ounces in total. So that may not be an issue pushing the gold price up, but it may be an issue supporting the gold price. So we're still looking at the price heading higher based on investment demand, but we're also saying be careful. We love for our investment clients to hedge their positions, and this is a good place to hedge. Silver prices have not performed quite as well. They did get over $35. That was our ultra short-term target in our trade recommendations. Got over $35 to like $35.07. It's come back off. As I said, it's about $33.45. We had been thinking that $33.50 might be a good re-entry point for short-term investors, ultra short-term investors. We're now thinking that maybe it goes a little bit lower to like $33 or $33.20 before it's all over. It did get down to $33.20, $33.16 earlier this morning. So a little bit of vulnerability there. Again, we're in the seasonal period of seasonal strength. Our expectation is once you get past April, you may see seasonal weakness in investment demand, in fabrication demand, in prices. And that seasonal weakening may be added to by investors becoming more acclimated and less nervous about the political and economic environment. Although the way things are right now, the investors could be much more radical. Platinum prices, actually, our short-term recommendation 10 days ago was that we thought the price could go up as high as $1,040 or so, and it got within $5 of that. It got within $4 of that. And then it's come off ever since that time. Our expectation is that the platinum price will continue to move sideways. And I put in this both a longer term, to both charts are longer term than we use for gold and silver. I took the bigger chart back to 2019, and the other chart goes back to 2000, just so that you can see that the gold price, the platinum price has basically traded really between 800 and 1100 for much of the last decade, 10 years. And our expectation is that that continues. And similarly with Palladium, we had a much more robust rally in Palladium from 2017 into 2022. But since that spike up when Russia invaded Ukraine in February of 2022, the Palladium price has come back off. And over the last year or so, it's been trading in a range of 800 to 1200, 1100, similar to platinum. And our expectation is that that's probably going to continue, and that Palladium may be a little bit more vulnerable on the downside than platinum. We won't have a video next Tuesday because we'll be launching our gold yearbook. You can go to our website and find a place to sign up to plug into that live discussion about the outlook for gold. We'll come out with our silver yearbook in May and our platinum yearbook in July. You can go to our website, get free reads, free videos, free reports. You can pre-order our gold yearbook, silver yearbook, platinum yearbook. You can buy other reports like our monthly precious metals advisory or our monthly base metals advisory. You can read about the work that we do on asset management advisory services and commodities management advisory services. And you can send a note to us at info@cpmgroup.com asking us to talk with you about how we can help you manage your commodities and precious metals price exposure in hopefully more efficient and effective ways. That's all I have for now. Have a good weekend. Take care of yourself. Take care of those around you. Try to do something good for the world, because on balance, the world needs more good things being done than the bad things. And right now we have a lot of bad things being done. Take care.